Welcome back. I'm Dhesi. Here's what matters this week. I'm going to skip the preamble today because what's happened over the weekend changes everything. The US and Israel struck Iran on Saturday, and the supreme leader Khamenei was killed. Iran also retaliated overnight with missile and drone strikes hitting Dubai's Jebel Ali port. Also, Saudi Arabia and Bahrain. The US also destroyed 9 Iranian warships, and the Iranian Revolutionary Guard declared the Strait of Hormuz effectively closed. Maersk has suspended all transits, largely driven by insurance withdrawal. That's doing most of the work, more so than a physical blockade. The first oil tanker was also attacked in the strait overnight. So this is not escalation, this is war. And sitting underneath every single trade this week. So 3 themes. No surprise, the first one is the Strait of Hormuz and what a closed choke point actually means. 20% of global oil supply passes through that passage. And I don't mean physically sealed, I mean insurance has withdrawn. Shipping has stopped. Maersk has also suspended transits, and 1 tanker has already been attacked. So you don't need a naval blockade to shut a shipping lane. You just need the insurance market to walk away, and it has. Brent has also peaked at $80 a barrel overnight, and that's up 13% from Friday's close of $72. It has eased back though to around $77.50. Also, as the Wall Street Journal reported, Iran has signaled intent to resume nuclear talks, and Trump may revisit sanctions if the new Iranian leadership proves pragmatic. So I think the key thing here is watch that signal very carefully. It might be real, it may not be. Either way, oil has been moving 13% in a weekend. And that's a price you can't ignore. OPEC has also agreed to raise output by 206,000 barrels a day from April. I'll be direct here. Look, that doesn't offset a closed choke point. And actually, to be honest, the market knows it. So for any treasurer or CFO running energy cost assumptions into Q1 and Q2, those numbers were built for a different world, the one that existed on Friday afternoon. So one more thing on this is that it's the detail most people are missing. Iran struck Dubai and Dubai's Jebel Ali port, and that is a commercial center, a capital flows hub. That the assumption that the UAE was insulated from this conflict, that assumption has now completely gone. So watch what that does to investment inflows into the Gulf through the rest of this week. Second, the Bank of England March cut is now in doubt. At Friday's close, the market had a 86% implied probability of a 25 basis point cut on 19th of March. And I'll be honest with you, that number does not reflect what happened over the weekend. Here's the trade-off the MPC now faces. An oil shock drives CPI higher. The same oil shock hits activity and squeezes output. So CPI above target, output below potential. And that is the definition of a central banker's nightmare. The doves will point to the activity hit. The hawks, however, will point to inflation persistence. And Bailey, as ever, is the swing vote. He's the casting vote on the MPC, and he now has to decide whether to cut into an energy price shock, or does he wait? So looking at sterling swaps, the 2-year is at 3.6%, 10-year is at 4.12%. If that market starts repricing March as a hold, the 2-year moves. And that changes the fixed versus floating conversation immediately. The spring statement is tomorrow as well. Reeves is going to the House of Commons, and in a normal week, that would be the main event. However, this week, it sits underneath a war. But watch for any signal on fiscal response to higher energy input costs. If she tightens, the gilt market reads that as a cover for the Bank of England to hold. Third, Treasuries. And here's the thing that surprises people. The conventional play in a geopolitical shock is flight to safety. Buy Treasuries, yields fall. That is not what's happening. The 10-year Treasury yield is at 3.97%, and that is higher than Friday's close of 3.94%. The curve is steepening, but yields are going up, not down. Why? Because oil at these levels is inflationary, and the bond market is pricing the inflation consequence of an oil shock, not the safe haven consequence of a geopolitical one. The transmission is oil, CPI, rates up, and then moving on to not oil, fear, rates down. So where are dollar swaps at the moment? 2-year at 3.5%, the 10-year at 3.4%. If this conflict extends, if the Hormuz stays functionally shut for weeks, not days, the curve can still steepen further. And the Fed faces the same impossible trade-off as the Bank of England. Cut into a weakening jobs market or hold because oil is about to push CPI higher again. On Friday, you have non-farm payrolls. The consensus is 60,000 against a prior 130k, and that number just got more complicated, not less. Okay, moving on to rates and funding. Look, no central bank decisions this week, but the rates market is being repriced in real time. The key insight from this pack is that treasuries are moving with inflation fears, not against them. The 10-year yield is higher, not lower, on the geopolitical shock, and that is not the default playbook. It is not the correct read for an oil price shock that we've seen to date. So dollar curve, as we said, 2-year at 3.5%, 10-year at 3.84%, and gilt, however, 2-year at 3.6%, 10-year at 4.12%, Euro swaps 2.14%, 10-year at 2.65%. So for anyone in fixed versus floating conversations right now, I'd be having that conversation today. Not after payrolls, not on Friday, today. Because if March Bank of England's goes from 86% cut probability to a genuine coin flip, the cost of waiting just went up. Okay, so moving on to FX and hedging. So there's two channels, both counterintuitive this week. The dollar first. The dollar index is winning the safe haven race, not the yen, not the Swiss franc. The dollar yen index is up 0.3%. However, the yen is actually weakening very slightly from 156 to 157, and the Swiss franc has barely moved. This is a dollar story, not a broad flight to quality, and that matters for how you frame hedging conversations. If you have dollar payables, dollar strength is working against you, and the geopolitical bid may extend it. You can see euro dollar on the screens as well as cable. Both are softer, both continuation moves, 1-day and 3-day pointing the same direction. Sterling is second. Cable is down across the board. The spring statement is tomorrow, and that is an additional risk. And now you layer in the Bank of England March cut repricing. If 86% probability starts moving towards 50, sterling does not like that. The window for hedging dollar receivables at current levels is then starting to narrow. Okay, moving on to commodities and inflation. I don't need to dress this up, to be honest. Brent has peaked at $80 overnight, up 13% in a weekend. It's eased to around $77.50, and that is off the back of the nuclear talks signal. That easing is not the most important single data point to watch this week. Does it hold? Does the de-escalation signal firm up? Or does Iran's retaliation make the nuclear talks story look premature? The difference between 77.5 and $80 is a difference between a manageable inflation bump and a CPI problem. That forces central banks to stop cutting. I've watched this long enough now to know markets price the story before the number confirms it. The story right now is oil shock. Inflation goes to rates stay higher for longer, and commodities are running with that. Gold is up above 5,375, as you can see on the screen, and that's up 3.4% today and up 7% in 10 days. Gold and oil moving together is not just an inflation trade. It is the market hedging a scenario it really does not want to be right now. Okay, looking at other markets, quick roundup. The S&P is at 6,817, down over 1% today, and the same over 3 days. Euro Stoxx is down 1.74% today, down nearly 2% in just over 3 days. European equities are more exposed to energy costs passing through, and now to the Gulf capital flow distribution. The Nikkei is also down just over 2% today. An interesting split inside it though. Energy sector within the Nikkei is up. Airlines within with Middle East exposure are down around 10%. So the index number hides a story. Look underneath the bonnet. Moving on to crypto, Bitcoin bounced overnight to up 1.8% in the Asian session, but the one-day move is still negative at minus 1.47%. Sunday's knee-jerk risk-off dump is being partially brought back, and I find this interesting. If crypto continues to bounce while equities keep falling, the risk-off is selective, not indiscriminate. And that tells you something about where the real fear is concentrated. Looking at credit spreads, US investment grade at 82 basis points, high yield at just shy of 300 basis points, Euro high yield at 264 basis points, and these have not moved yet. And in my experience, that's the number to watch. When credit starts to move, that's when the story goes from geopolitical noise to systematic concern. So keep an eye on it through the rest of this week. Okay, looking at the week ahead, the calendar is already a heavy week, and also it's now carrying a war on top of it. Okay, so looking at Monday, today, Lagarde speaks alongside a couple of other speakers. First, ECB communication since the strikes. So what they say about energy and the inflation path really matters, and it matters immediately. Also, Bank of England's Taylor speaks in Oslo. You have also the US ISM manufacturing. Consensus is 51.8, prior is 52.6. And this data is pre-shock, but watch the tone and any forward guidance language. On Tuesday, the busiest session of the week, Eurozone flash CPI, 1.7% year-on-year consensus, core at 2.2%, and this is pre-shock data, but it sets the baseline for a conversation that just got more complicated. Then Chancellor Rachel Reeves has a spring statement at 12:30. And in a normal week, that would be the main event. This week, watch her response to the new energy environment. Any signal on fiscal tightening changes the gilt and Bank of England story. Moving on to Wednesday, China PMIs overnight. Watch for any supply chain language on Middle East disruption. You also have US ADP, employment consensus, which is at 42,000. ISM non-manufacturing at 53.8. Also have the Fed beige book, and that should give you color on energy input costs. Let's see what the read is. It's going to be very important to read the details on that. Thursday, US initial jobless claims, unit labor costs for Q4. Consensus is 2.2% against a prior minus 1.9%. That swing in the cost picture matters more now, not less. Lagarde speaks again in Bologna. And then moving on to Friday, the main data event, you have NFPs. Consensus is at 60K, prior was 130K. Also, unemployment rate, average hourly earnings alongside that as well. But here's how this number is now being read. It's not just a jobs number anymore. It's the first major economic signal of how the US economy enters an active Middle East conflict. Wheat jobs plus oil at $77 plus. Is the Fed's impossible trade-off made absolutely real? And underneath all of that, all week, I would say, look, watch Brent. Watch whether $77.50 holds or if it gives back to $80. And also watch whether the nuclear talk signal firms up or completely evaporates. That signal, that single variable, will drive more market moves this week than any data release on this calendar. And that's the honest truth of it. So please do keep an eye on that. That's your week ahead. Bookmark it, come back on Friday, see how it aged, subscribe if you want the next one, and drop the one level you're watching down below.